So friends, what is leverage? Leverage is basically the magnifying effect on the profitability numbers, especially, which happens by introduction of financial or non-financial fixed costs into the system. So let us write the definition. So leverage is the magnifying effect that happens due to the introduction of fixed costs, which can be financial or non-financial in nature. When the fixed cost is non-financial in nature, the leverage is called operating leverage. And when it is financial in nature, the leverage is called financial leverage. Let's take an example, friends. Let's say a company has the following revenues in the 5 years without any leverage, without any additional leverage. Let's say it is 110 crore, 70 crore, 90 crore, 130 crore and 100 crore. These are the sales yearly. Now this is without the operating leverage or financial leverage of any kind. Now what happens is a certain amount of operating leverage and financial leverage is added. Let's say a new plant is added which is having an expense of 50 crores, and that 50 crores is divided between debt and equity into 25 crores and 25 crores. So 25 crores maybe the company uses from its own balance sheet cash, and 25 crores it takes as loan. Now the repayment will happen uniformly across the future 5 years. So this 25 crores is the total expense for financially, and this 25 crores is also in terms of operating leverage also the total expense. So this increment in cost is 5 crores in each year, right? Now let's say the introduction of this plant results in increase of revenue by 15 crores each year. So the new set of revenues becomes 125, 85, 105, 145 and 115. So this is an increment of 15 crores each year that we are assuming, right? Now let's say the variable cost is 50%. Variable cost is 50%. And the fixed cost, both financial, non-financial included, before addition of this additional cost or additional leverage, this was 20 crores. So we write these numbers 20, 20, 20, 20, 20, right? And this is 50%. So for the new net income, the variable cost is 62.5, 42.5, 52.5, 72.5 and 57.5, right? So these are the costs. Now if we have to find out the new net income, this comes to be the new net income. This will be calculated as 125 minus 62.5 minus 20 minus 5 minus 5, right? So we do the calculations, guys. This comes to be 32.5. This is 12.5. 22.5. 42.5. 27.5. These are the new net incomes, right? These are the new net incomes. What about the old net incomes? So old net income will be, for example, for time 1, this will be, let me use different colors here, 110 minus 62.5 minus 20. So old net income without the addition of the financial leverage and the operating leverage, this will be equal to 110 minus 62.5 minus 20. So this is equal to 110 minus 27.5. Is 22.5. So you can see there is an increment of 5 CR in every of the values. So this is the magnification that we are talking about. This magnification has been achieved by the addition of financial leverage and operating leverage. Now there is a downside to it, my friends. Let's say the revenues increased anywhere between 0 to 10. That is, whatever cost got added, the added revenue was less than that. Let's say the added revenue was only 7 CR each time. So the new revenues become, let us write the new revenues in this scenario. The revenues in this case become, so we have increased the revenues only by 7 crores by adding this additional cost, right? So this is 117, this is 77, this is 97, this is 137, this is 107. So these revenues, we add 7 crore to it. Now the expenses remain the same. This is 5 plus 62.5 plus 20. So we have to reduce that. Let us see what is the new expense coming. This expense is coming to 5 plus 5 plus 62.5 plus 20. This is coming to 92.5. Therefore, the profitability here is coming to be minus 117 is 24.5. So the old net income would have been 27.5, but because the expense that got added was not compensated by the resulting revenue increment, the new revenue in this case, in this second scenario, that is the new net income in this second scenario, actually decreased. Instead of increasing, it went down to 24.5. Similarly, if you calculate all these values, you will see there is a reduction in 3 CR in profitability. So this will become 4.5, this will become 14.5, this will be 34.5, and this will be 19.5. So all of them will be reduced. So this is basically what we mean by the magnifying effect. Either we are amplifying the net income or we are de-amplifying it by addition of leverage. If the addition of leverage is successful, we end up magnifying it positively. If it is not successful, then we end up de-magnifying it or magnifying it negatively. Now next we are going to get into the activity ratios.